Hello and welcome to this video on ratio analysis. In this video we're going to evaluate the use of ratio analysis. So we've looked at three main categories of ratios. We've looked at profitability, liquidity, and the long-term liquidity, which is the gearing ratio. Now, who would be interested in these ratios? Well, shareholders will be interested in profitability, and the government, and competitors, and employees. In terms of liquidity, we're thinking in particular suppliers, creditors to the business, lenders, but also the shareholders to see if the business will continue to exist. In terms of long-term liquidity, who would be interested in this? Again, shareholders, lenders, and maybe also competitors would be interested in looking at long-term liquidity in the gearing ratio. So different stakeholders will be interested in analysing the financial performance of the business in different ways. So how might we interpret some of these ratios? Well, the return on capital employed may tell us that a business needs to use its capital more efficiently and generate more profit if there is a decline in return on capital over a period of time. The gearing ratio needs to be closely monitored to avoid the situation where we might have very high gearing, which could cause problems if sales decline. If a business is looking to expand, they might always look at the gearing ratio to see whether the business can sustain an extra loan in order to fund this expansion. Gross profit margin. Increasing margins suggest the business might be able to reduce its selling price to perform even better, whereas decreasing gross profit margins indicate that we either need to raise prices or we need to do better at controlling our variable costs. The net profit margin. If we have a stable gross profit margin and our net profit margin is falling, this tells us as a management team or as a business or as a stakeholder that this business is having a problem with overheads and that these extra overheads aren't actually adding anything to the profitability of the business. Liquidity, we're very interested in the current ratio and the asset test ratio because poor liquidity poses a big, perhaps the biggest short-term problem for a business, and that's we can't get a hold of enough cash to pay our debts and risk insolvency and possibly the failure of the business. So ratios are very useful to analyse the performance, but what are some of the limitations or the drawbacks of ratios? Well, we need to compare them over time to gain an understanding of the levels and the direction in which these ratios are going. A low ratio, a profit margin might be, and we might think it's bad, but actually if we see it's on a very steep upward trend, actually this is not as bad as we first thought. Ratios are only as useful as the quality of the financial documents on which they're based. A statement of financial position is only a snapshot at a particular point in time of a business. It doesn't tell us anything about the future, and so may therefore be subject to change. We always need to think about putting the figures into context, so comparing them with competitors to understand what might be a factor which is the responsibility of the business and one which might be just a general market issue overall. Ratios don't tell us anything about qualitative factors, perhaps such as the quality of the leadership or the management. We might have a poorly performing business, but they just replaced the leadership team with someone highly skilled and effective, and we haven't seen that come through yet. It doesn't tell us about the quality of the workforce, the corporate culture, the degree of customer loyalty. These are not figures that appear in these financial statements. The impact of the product portfolio and any product that's in development or any products that are in decline are often ignored. We're looking just at a period of time rather than what the future holds or the trend for existing sales. External economic factors or changes in a firm's competitive environment aren't reflected in the statements. And even if we look at a ratio, we must always try and explore, really make sure we understand the reasons behind a ratio. We might see declining return on capital employed than in previous years, but that's maybe because the business is investing heavily in assets and we haven't yet got the return from that investment that's going to come in the future. And so the declining return on capital employed might be a slightly misleading picture. We need to really make sure we explore the reasons behind ratios as well. So in this video we've looked at why ratio analysis might be useful, but also looked at some of the potential limitations. That's it. Thank you very much for listening.